They told you the rally was unstoppable. They told you gold was going to $6,000 by summer. They told you silver was heading to $150, maybe $200, that the squeeze was just getting started and anyone not positioned would be left behind crying about what could have been. And now, in the span of hours, gold has crashed below $5,000 and silver has broken below $100. Two massive psychological levels, two lines in the sand that everyone said would hold, both gone, both shattered. And now the same voices that were screaming by are suddenly very, very quiet. But here's what really bothers me. This move didn't come out of nowhere. There was a signal, a clear, measurable signal that has predicted major reversals in precious metals for decades. And almost nobody was talking about it while the rally was running hot. They were too busy counting gains that hadn't been locked in yet, too busy imagining future prices that might never arrive, too busy ignoring the one indicator that has consistently provided directional clues when everything else looks like noise. I'm talking about the gold-silver ratio. And if you don't understand this ratio, if you don't know how to read it, if you can't see what it's been doing over the past few months, you're navigating this market with a blindfold on. Today, I'm going to take that blindfold off. I'm going to show you exactly what the ratio has been telling us, why it matters more than most of the technical analysis you'll see online, and what it suggests about where gold and silver are headed from here. Quick favor before we dive in. I'm building something real here at Financial Crux, and that means providing analysis that goes deeper than the surface level panic you're seeing everywhere else right now. If you find value in what we do, support the mission by subscribing and dropping a comment below. And if you want the fast updates that don't always make it into full videos, especially during volatile periods like this, join the WhatsApp community and follow us on X. Links are in the description. Let's get into it. I want to start by acknowledging what just happened, because the numbers are genuinely shocking, even for those of us who've been watching precious metals for years. Gold futures dropped below $5,000. At the lows, we saw prices around $4,184. That's a decline of approximately 7% in a single session. For an asset that many people treat as the ultimate safe haven, the bedrock of financial security, that's the kind of move that makes you question everything you thought you knew. But silver got absolutely destroyed, down more than 17% to around $95, $79. Think about that for a second. If you had $100,000 in silver exposure yesterday, you woke up today with $83,000. In one day, no warning, no chance to exit gracefully. Just a gap down and a cascade of selling that didn't stop until major psychological levels were in the rearview mirror. The $100 mark for silver and the $5,000 mark for gold. Both breached, both broken, both now serving as potential resistance on any bounce rather than the support they were supposed to provide. That's the kind of technical damage that takes time to repair. Now, the natural question everyone is asking is why? Why did this happen? Why now? And could we have seen it coming? The honest answer is yes, we could have seen it coming. Not the exact day, not the precise magnitude, but the direction and the vulnerability were clearly visible if you knew where to look. And the place to look was the gold-silver ratio. Let me explain what this ratio is and why it matters, because this is fundamental knowledge that separates informed investors from the crowd that's always surprised by these moves. The gold-silver ratio, sometimes written as XAU-XAG, is simply the price of gold divided by the price of silver. It tells you how many ounces of silver you would need to buy 1 ounce of gold at current prices. When the ratio is high, silver is cheap relative to gold. When the ratio is low, silver is expensive relative to gold. But here's the insight that most people miss. The ratio doesn't just tell you about relative value, it tells you about market dynamics. It tells you about momentum. And most importantly, it has a remarkably consistent inverse correlation with the direction of both metals. When the gold-silver ratio is falling, it typically means both gold and silver are rising, but silver is rising faster. That's what you see during aggressive bull runs. Silver plays catch-up, the ratio compresses, and everyone gets excited about how silver is outperforming. When the gold-silver ratio is rising, it typically means both gold and silver are falling, or at minimum, silver is falling faster than gold. That's what you see during corrections and bear phases. The ratio expands as silver gives back its gains more aggressively than gold. This relationship is not perfect. Nothing in markets is perfect, but it's consistent enough that paying attention to it gives you a significant edge over people who are just watching price charts and wondering why everything suddenly reversed. Now let me walk you through the timeline of this entire move, because the ratio has been telling a story that almost nobody was reading correctly. Let's go back to April 7th, 2025. That was the low point for this entire cycle. Gold futures bottomed at $2,970.67. Silver futures bottomed at $29.24. And the gold-silver ratio, it was sitting at 105.44. That's an extremely high ratio. It was screaming that silver was massively undervalued relative to gold. And what happened next was exactly what the ratio predicted. Both metals began a massive bull run, with silver dramatically outperforming as the ratio compressed. Fast forward to October 20th, 2025. Gold futures hit their first record peak at $4,098.29. Silver was trading at 51.54. The gold-silver ratio had compressed all the way down to 82.89. That compression reflected silver's outperformance during the rally phase. But here's where it gets interesting. The very next day, October 21st, gold experienced a single-day decline of more than 6.86%. The ratio started moving up. That was the first warning shot. Then we get to October 28th. Gold found support at 3,296 after that initial correction. Silver found support at 46,999. The ratio was at 83.58. Both metals then resumed their uptrend, with silver pushing to new highs at 53.77. The bulls thought they had weathered the storm. The correction was over. Back to new highs. Nothing to worry about. But the ratio was watching. The ratio was waiting. November 21st, 2025. This is a date that should be burned into the memory of anyone trading precious metals. The ratio hit a high of 82.89 and then began a steep decline. But wait, I said the ratio falling is bullish, right? In this case, the decline from 82.89 was actually the ratio normalizing before its next major move. What happened next was the real signal. By December 29th, 2025, the ratio had fallen all the way to 54.23. Gold was testing new peaks at 4,145.54. Silver was exploding higher to 79.59. The ratio compression was extreme. Silver was massively outperforming. The bulls were euphoric. And then we get to January 1st, 2026. This is the date that matters most for understanding what's happening right now. The gold-silver ratio tested a low of 43.32. Let me repeat that, 43.32. That's one of the lowest readings in decades. It meant that silver had become extremely expensive relative to gold. It meant that the compression had gone too far, too fast. It meant that a reversal was likely. And what happened? Gold tested a record peak at $5,726.47. Silver tested a record peak at 121.75 on January 29th. The exact moment of maximum optimism. The exact moment when everyone was convinced that precious metals could only go higher. That was the moment the ratio was flashing its loudest warning. Because here's the thing about extreme ratio readings, they don't last. Markets are mean reverting mechanisms. When silver gets too expensive relative to gold, money starts flowing back the other way. When the ratio gets pushed to extremes, the rubber band snaps back, and that's exactly what we've been watching. The ratio bottomed on January 26, 2026, and has been reversing ever since. That reversal in the ratio is what's driving the selling pressure we're seeing in both gold and silver right now. It's not random. It's not manipulation. It's not some mysterious force. It's the oldest relationship in the precious metals complex doing exactly what it always does. Now, I want to explain why the ratio analysis gives us something that pure price analysis can't provide. It gives us directional clues that come before the price moves. Think about it this way. If you're only watching gold's price, you see a rally, then a peak, then a decline. But you don't know if the decline is a brief pullback or the start of something bigger. You don't know if the momentum is truly shifting or just taking a breath. But if you're watching the ratio, you see the compression approaching historical extremes. You see the momentum in the ratio slowing before the price peaks. You see the reversal pattern forming in the ratio days before the price follows. The ratio leads, price follows. This is not theory. This is what happened in the current cycle. The ratio hit 43.32 before gold peaked at 5,626. The ratio started rising before gold started falling. The ratio gave you warning. The only question is whether you were watching. Now let's talk about what the ratio analysis suggests for where we go from here, because this is what everyone wants to know. And I'm going to be honest with you, the picture is not pretty for the short term. The ratio has clearly reversed from its January lows. It's broken above initial resistance and is now targeting higher levels. Based on the analysis of this pattern, if the ratio finds a breakout above the immediate resistance at 48.81 and sustains that level, it could push toward the next resistance at 54.23. And if that level breaks, we're looking at potential moves toward 59.93. What does that mean in terms of actual prices? If the ratio reaches 59.83, which is the upper target zone, the corresponding price levels would suggest gold futures testing lows around $4,398 and silver futures testing lows around $78.89. Let that sink in for a moment. Gold at $4,398 would be another 12% decline from current levels. Silver at 78.89 would be another 18% decline from current levels. On top of what we've already seen, that's the scenario the ratio is projecting if this reversal continues to its logical conclusion. Now, I want to be careful here because projections are not guarantees. Markets can surprise, the ratio could stall at current levels, a major catalyst could shift the entire setup. But the pattern is clear, and ignoring clear patterns because you don't like what they're saying is how people lose money. The honest assessment right now is that the correction has further to go. The ratio reversal is still in its early stages. The momentum has shifted from buying dips to selling rips. And the cascade effect that we're seeing, where profit-taking begets more profit-taking, is exactly how these corrections unfold. Here's an analogy that might help. Imagine a ball rolling down a hill. At the top, you can stop it with minimal effort. But once it gains momentum, stopping it becomes increasingly difficult. The further it rolls, the more energy it accumulates, and the harder it becomes to reverse. That's what's happening in precious metals right now. The reversal started, the momentum has shifted, and now we're in that phase where trying to catch the bottom is like trying to catch a falling knife. You might get lucky, but statistically, you're more likely to get hurt. There's a phrase that experienced traders use in situations like this. Don't try to be a hero. It sounds simple, but it captures something profound about market psychology. When everyone around you is panicking, there's a temptation to be the contrarian, to step in and buy when others are selling, to prove that you're smarter than the crowd. Sometimes that works. Sometimes the contrarian is right and the crowd is wrong. But more often, especially in the middle of a cascading correction, the contrarian gets run over by the same momentum they thought they were fading. The time to be contrarian was when the ratio was at 43.32 and everyone was talking about silver to $150. That was when the crowd was wrong. That was when stepping aside or reducing exposure would have saved you from what's happening now. Today, with the ratio reversing and momentum clearly shifted to the downside, being contrarian means fighting a trend that has more room to run. That's not smart, that's stubborn. And stubborn is expensive in markets. So what do you actually do in this situation? Let me give you a framework because frameworks are more useful than predictions. First, accept that the correction is happening. This sounds obvious, but many people are still in denial. They're hoping for a quick bounce. They're telling themselves that the fundamentals haven't changed, which is true, but fundamentals don't determine short-term price action. Positioning, momentum, and technical levels determine short-term price action. And all of those are pointing down right now. Right? Second, identify your exit strategy or your hold strategy, but have a strategy. If you're a trader with leveraged positions, you should have already been stopped out, or you should be looking for exit points on any bounce. If you're a long-term holder with physical metal or unleveraged positions, you can afford to sit through this, but you should have a clear understanding of why you're holding and what would change your mind. Third, don't add to losing positions hoping for a reversal. This is the mistake that turns manageable losses into catastrophic ones. Averaging down in the middle of a waterfall decline is how accounts get blown up. Wait for stabilization. Wait for the ratio to show signs of topping. Wait for the technical damage to be repaired. Fourth, watch the levels. For gold, the target zone around 4,398 based on the ratio analysis represents significant support that could attract buying interest. For silver, the 78.89 zone is the corresponding level. These are not guaranteed bottoms, but they're informed targets based on the ratio relationship. Fifth, remember that corrections end, every single one. The fundamental drivers that created the bull market in precious metals have not disappeared. Government debt is still massive and growing. Currency debasement pressures are still present. Geopolitical uncertainty is still elevated. Central bank buying is still ongoing. Industrial demand for silver is still strong. All of those factors remain in place. What's happening now is a correction within a larger bull market, not the end of the bull market. But corrections within bull markets can still be painful, extended, and destructive for those who refuse to respect them. Now, I want to address the emotional component because I know many of you are feeling things right now that go beyond simple analysis. If you were fully positioned going into this decline, you're experiencing real losses. Not paper losses that you can dismiss as temporary, real meaningful losses that affect your net worth, your confidence, and your sleep. That's hard. I'm not going to pretend it's not hard. But here's what I need you to understand. The decisions you make in the next few days will have more impact on your long-term results than the losses you've already experienced. Selling the bottom in a panic would compound the damage. But stubbornly adding to positions without a plan would also compound the damage. The goal right now is to stabilize your psychology before you make any major decisions. Don't trade from a place of fear. Don't trade from a place of denial. Trade from a place of acceptance, analysis, and patience. There will be an opportunity to buy back in at lower prices. There will be a moment when the ratio stops rising and starts to stabilize. There will be a point where the risk-reward shifts back in favor of the bulls. That point is not today. That point may not be this week. but that point will come. Your job right now is to be ready for it. That means preserving capital. That means not throwing good money after bad. That means watching the ratio and waiting for confirmation that the momentum has shifted again. Let me share something about market psychology that applies to this exact situation. Markets exist to transfer wealth from the impatient to the patient. That sounds like a greeting card platitude, but it's deeply true. During rallies, the impatient chase prices higher, paying premiums because they can't stand the idea of missing out. During corrections, the impatient panic out at the lows, locking in losses because they can't stand the pain. The patient wait. The patient accumulate when prices are reasonable. The patient reduce exposure when things get extended. The patient survive the corrections and compound wealth across cycles. Which group do you want to be in? That's not a rhetorical question. Your answer will determine your results, not just in this cycle, but in every cycle you participate in for the rest of your investing life. Now let me pivot to what comes after this correction, because that's ultimately what matters for long-term wealth building. The fundamental case for precious metals has not changed. Let me list the factors that drove the bull market, and you tell me which ones have been resolved by this correction. Government debt levels, still at record highs and growing. Nothing about this correction changes the fiscal trajectory of major economies. Currency debasement, still ongoing. Central banks are still manipulating money supplies. Real purchasing power is still being eroded. Geopolitical uncertainty, still elevated. Conflicts are ongoing. Trade tensions are unresolved. Alliance structures are shifting. Central bank gold buying, still happening. The de-dollarization trend has not reversed because gold dropped below $5,000. Industrial silver demand, still growing. Solar installations are still expanding. Electric vehicle production is still increasing. 5G infrastructure is still being built. None of these factors cared about gold's price yesterday. None of them care about gold's price today. They exist on a timeline that's measured in years and decades, not days and weeks. That's why I say the fundamental case is intact. The correction is real. The pain is real. The losses are real. But the underlying reasons for owning precious metals have not changed. What's changed is price. What's changed is positioning. What's changed is the short-term momentum, and those things will change again. They always do. The question is whether you'll be positioned to benefit when the momentum shifts back, or whether you'll have been shaken out by the volatility and left watching from the sidelines. Here's my question for you, and I genuinely want to see this discussion in the comments. Were you watching the gold-silver ratio before this correction? Did you see the warning signs? Or is this the first time you've really paid attention to this relationship? There's no wrong answer, but your answer reveals something about your preparation and your process. Drop your thoughts below. And if you've navigated previous corrections by watching the ratio, share what you've learned. That kind of real-world experience is invaluable for the community. Before I wrap up, let me remind you that the links to the WhatsApp community and X are in the description. During volatile periods like this, the real-time updates matter more than ever. By the time I can produce a full video, prices may have moved significantly. The WhatsApp community and X feed provide the quick takes that help you stay informed as situations develop. Let me leave you with some thoughts on what to watch going forward. For the ratio, watch the 48.81 level. That's the immediate resistance. A sustained breakout above that level confirms the reversal has legs and targets the higher zones at 54.23 and potentially 59.93. For gold, watch the $4,800 to $4,900 zone. That's where we might see initial stabilization attempts. But if that fails, the ratio implied target of 4,298 comes into play. For silver, watch the $90 to $95 zone. Same dynamic. Initial stabilization attempts might occur there, but if that fails, we're looking at potential moves toward $78 to $80. For the overall market, watch for signs of exhaustion in the selling. That might look like a gap down that gets bought aggressively. It might look like a high volume session that closes well off the lows. It might look like the ratio finally topping out and rolling over. Until you see those signs, the path of least resistance remains lower. And fighting the path of least resistance is how accounts get destroyed. One more thought on the broader context. What we're experiencing right now is not unusual. It feels unusual because it's happening to us in real time with real money, but zoom out and look at history. Every precious metals bull market has featured corrections of this magnitude. Some featured corrections even larger. The 1970s gold bull market had multiple corrections of 30% or more on its way to ultimate highs. The 2000s bull market featured several corrections of 20 to 30% that shook out weak hands before resuming higher. This is how bull markets work. They climb a wall of worry. They shake out the uncommitted. They reward only those with the conviction and the capital to stay in the game. The people who sold the 1976 correction missed the ultimate highs in 1980. The people who sold the 2008 correction missed the ultimate highs in 2011. Will the people who sell this correction miss the ultimate highs of this cycle? That's the historical pattern. That's the tendency. That's what the evidence suggests. But you have to survive to participate. And surviving means respecting the correction while it's happening, not pretending it doesn't exist or stubbornly adding to positions that are moving against you. All right, that's everything for today. I'm going to leave you with a line that captures this moment perfectly. The correction will end when it ends, and then we can go back to looking at the fundamentals again. That line comes directly from one of the analysts covering this move, and it's exactly right. Right now, fundamentals don't matter. Momentum matters, the ratio matters, technical levels matter, positioning matters. When the dust settles, we'll return to discussing the structural bull case. But the dust has to settle first. Stay sharp, stay patient, and don't let the pain of this correction steal your ability to participate in what comes next. This is Financial Crux. I'll see you in the next one.